Hello, Smart Money Tree podcast listeners. Welcome to this week's show. My name is Kirk Chisholm, and I will be your host. So today, I'm joined once again with Doug Heagren. Hey, Doug.
Hey, Kirk. Hope nobody's getting sick of me yet.
No, hope not. I haven't gotten any hate mail, which I don't know if that's a sign people aren't listening or they're really happy with you. In this day and age, if you're not getting hate, I don't know what to think.
I'm not trying hard enough, and I'm clearly not doing my job. If people don't hate it, then I'm just being way too boring. So,
well, maybe I'll send you some hate email, Doug, just to make you feel better.
Perfect. Please do.
All right. Well, this week we're gonna follow up on a few things. So we talked about the bullwhip effect last week, which I thought was really interesting. We got a lot of positive feedback on that. It's one of those things you probably never even heard of. I did. It's funny because I hadn't even heard it anywhere in the news yet. Starting to see some trickles on it. Maybe it's because people listen to the show, but the bullwhip effect is in coming in due form here. So, Doug, talk about what you're seeing. I know you pulled up some stories here, but what are you seeing here with the bullwhip effect?
Yeah, well, I mean, again, we talked about last time that the COVID created just this incredible discrepancy between supply and demand, and we're starting to see actually some numbers come in that some of the biggest warehouses in America are starting to run out of room. And we talked a little bit last time too about avocado prices becoming, they're trying to give them away. I mean, they're 1/10 the price of a head of lettuce in Australia. But now we're starting to see it goes beyond that. We're starting to see that the largest warehouse in America, which is out of San Bernardino area, California, that there is a slowing of clothing, there is an overstock of clothing, electronics, furniture, other goods because what's happened, again, we go back to the definition of a bullwhip, right? There was this huge demand. Everybody was trying to get everything. Everybody thought, we thought people were going to be at home. So they needed new products to be able to make these homes livable and also good for business. And now we've seen a massive spike in prices, and we are starting to see that there is data coming in that all of this extra supply that was being produced and more ships now coming with more stuff have nowhere to go. That these warehouses are not able to distribute out the products that they are bringing in to these warehouses fast enough to be able to overcome what will ultimately be an incredible effect on supply and demand.
Yeah, I couldn't agree more. I think this is, like we talked about last week, this is just getting started and we're going to see it. And I think the interesting thing is we all think about the world naturally in sort of a binary way, and we think about it in a simplistic way. We're thinking, oh, well, does that mean the market's going to be up or does it mean it's going down? Well, if you've watched earnings so far, you see it's both, right? Some companies have surprised massively to the downside. Some companies have surprised massively to the upside, some on the same day. And, I think it's interesting because, people look at this and say, oh, well, the market's going up. It just means earnings are better. Well, not necessarily, right? I mean, the jobs numbers just came out today and they were unexpectedly better than people thought. And, is that a good or a bad thing? I don't know. Like it depends on who you talk to. I think if you really want to know if it's a good or bad thing, you look at how the market reacts to it. I think that's the real answer because the market is an aggregate of everybody who's trading stocks. So I think whether it goes up or down, you can judge whether it's a good or bad thing. But I think normally you'd think, hey, that's a great thing. The market's, it's running on full steam. The problem is we have high inflation. So if the market is taken off and everything's great and prices are taken off, well, that's a problem because that leads to continuous high inflation. And if the Federal Reserve doesn't do anything, that continues on and eventually hits hyperinflation. Now, they're not dumb enough to do that. They're well aware of that risk. And at some point, they're going to decide to fight inflation. I mean, right now, interest rates are still well below, like 7%, approximately below where inflation rate is. So you've got a huge gap between interest rates and inflation. But eventually, that's going to have to close at some point, and it will. And when that happens, obviously, at some level, that's going to push us, or at least certain industries, into recession. We're starting to see some of that impact. What else are you seeing, Doug? Because you had mentioned a few other things that were in the news and the impacts of those higher interest rates and inflation.
Yeah, well, you mentioned something really interesting in terms of 7%. How high is it? Listen, I don't know about the ages of everybody that listens to this podcast, but that's still lower than I remember paying or receiving coming out, coming out of college back in the early, mid 90s. I mean, my first CD was paying me 10%. Okay, so my first mortgage was over 7%. So I think there's definitely something here that needs to be taken into perspective. One thing also I want to add to on the warehouse side of things that we're seeing is that, and again, this is another bullwhip issue, is real estate. There was a tremendous spike in demand to acquire warehouse space based off of the huge demand that was there, and this belief that we're going to need to find a place to start putting stuff. And they're actually, this area that I was talking about, California, is visible by space. It anchors an industrial corridor encompassing 1.6 billion square feet of storage space that extends from the seaport of Los Angeles to near Arizona. It's 44 times larger than New York City's Central Park and 160 times larger than Tesla's Gigafactory in Texas. Okay, so all of a sudden you have this huge demand to go buy up that space. What's that do to the real estate market? Right now, bullwhip effect. Real estate prices go up on warehousing. Now all these people that bought these warehouses, if they can't move stuff out, and we start to see a significant shift in supply and demand of those products, again, where's that going to lead to? The other thing we're starting to see, just some ominous data, is we're starting to see that we've had a massive spike in default rates on autos, moving from 30 days late to 60 days late. And so we've seen this before. It doesn't necessarily mean that it's going to pull back. A lot of this is happening just looking at some charts and data in the South. But I think it's another sign that, if you go, I hear this, well, I go to the airport, everybody's traveling. I go to the store, everybody's buying. We live in our bubbles, right? The reason people keep up on the Joneses because they think everybody around them is doing well. But the reality is this is just another sign that, again, what you might not see is an indication of what's really going on. And when these economic shifts start to occur and we start to see, an impact, I already said it, I think I said it last time, we started to see the stocks of, Dollar Tree and some lower priced retail, stores starting to spike because people were trying to adjust their budgets. This is another sign, I think, that there's some real impact to some of the lowest incomes in America, which is a good segue to talking about income inequality and what's happened over the last 20 to 30 years. And again, who gets hit worst in these situations?
Yeah, and actually that's a good segue into my next piece here, which is looking at some of the other news that came out. There was the biggest jump in credit card debt in over the last 20 years. There was a 13% jump so far up to the end of Q2, and increased about 100 billion over the past year, 46 billion this quarter alone, and 123 million new credit cards were opened during Q2. I don't know where they got that number, but that seems a little bit ridiculous. That means that pretty much almost every single person in this country opened up a new credit card. I know I didn't. Did you, Doug?
Well, I didn't, but I do know college football season is coming soon, and they're probably giving away some T-shirts to your favorite team. That might be part of it, although that usually happens during the season when the games start, not before. But maybe that was it.
I don't think Big Tony down in the corners takes credit cards, Doug. So,
okay,
for football season anyway. So yeah, but getting back into it, I mean, really, what that says is it's a sign that consumer debt is rising, which means people can't afford their current expenses, right? And this comes back to what we've been saying over and over: inflation hurts everybody equally, but it harms the people in the lower socioeconomic classes more because they don't have that extra wealth that the wealthy have. The wealthy, if if things go up, it doesn't affect them to the same extent, but everybody loses the same amount, just not proportionally for what they're making and what they owe. So really, higher inflation is a tax on poor people, and actually the middle class quite a bit as well, because the middle class are usually, they're usually on the fence. They've got the same expenses as everybody else, but then they're trying to push to the upper class, keeping up with the Joneses. So all of those expenses kind of eat away at their wealth, and you have a lot of people. I remember this in the early 2000s and 2009, 10, 11, where a lot of people were what I call hollowed out, which is they spent well in excess of what they were earning. they're well above their means. They're keeping up with the Joneses. They have like 5 cars, 2 houses, can't afford any of it, but they're doing it because they're living off of the wealth creation that was going on. And as soon as that reverses, all those people, they're, like you said, repo their cars. They got to sell their houses. There's a huge segment of our population that's like that. And it's the middle class that, they're not comfortable with where they are. They want to be better. And it's hard to live in that higher stratosphere. So I think in many ways, this leads into the next topic, which is the income equality in the US. This is a really important topic. And this becomes highly politicized. So we're going to try not to make this politicized on this conversation. I'm sure it will, but it's such an important topic. And we're going to show you a chart here of the visual history of the income equality in the US. Now, this is actually a blog post I put out a number of years ago. I think it was back in, I don't remember, but it was over 5 years ago. And this goes up to about 2012 in the stats. So it doesn't have the most recent ones, but I think you get the picture by looking at this. So if you look at this chart, I want to point out here, the income growth from 1917 to 2012. If you see in the first part up until about 1940, it was pretty even, right? So it shows the top 1% of earners and the bottom 90% of earners. And they were pretty much even. They both kind of stagnated around the same area. And then around 1940, the bottom 90% of earners, the income growth took off up until about 1972. And it skyrocketed well in excess of the top 1%. And, you could say, well, what happened there? Well, we'll get to that in a minute. I just want to explain the chart. And then about 1972, because we have some listeners here that may not be able to see it. And if you can't, please go to YouTube and check it out. Around 1972, the bottom 90% of earners flatlined up until pretty much today. And right around 1980, 81, 82, all of a sudden the top 1% of earners skyrocketed. And now people talk about this income equality, which is important, right? When you have these CEOs of companies making $300 million a year, and you have Joe and Susie Lunchbox making, 50 grand a year, 70 grand a year, there's a huge discrepancy. And we're in a politically divisive time where people want to find a target. They want to find a scapegoat. And of course, let's target the rich, eat the rich, right? Why not? Not always the best policy. I'm not saying that it's, that they shouldn't earn 300 million a year. I'm pretty sure they haven't earned all of that money. They haven't deserved it, but I'm sure they've earned it well enough. But the point is there's a huge discrepancy in people looking for a villain. And the wealthy are a normal villain, especially if you look back in history. Every cycle, they call this the fourth turning. Every fourth turning, they always find villains, and typically it's the rich who get targeted. So it's not surprising that that's the case. But I want to point out a few things. First of all, there's a few things that have happened over that time period. So one is if I look at like historical tax rates, and we're going to put all of this up on YouTube and charts, and I'll put this in the show notes on our website as well. If you look at tax rates in the US, the historical tax rates for the marginal income rates, they really, right now we're in the 40s or upper 30s in the highest rate. But if you didn't know, they went as high as 94% on the federal side for the marginal tax rate. 94%, if you can believe that. Now, that was World War II. And of course, they're trying to pay for the war, which, I think we can all understand. But even after that, even into the 60s, it was in the 90 percentile. And it wasn't until the mid to late 60s that it actually went down into the 70s. And it was really into the early 80s where around 81, the Economic Tax Act of 81, where it dropped into the 50s, and then the Tax Reform Act of 86 and went down into the 30s. So if you look at history, there was a huge period of time where the wealthy, it didn't pay to be wealthy because you're in terms of income, right? If you made high income, then you got dinged, and there's actually some Scandinavian countries which have this too, which is if you make more than a certain amount, I think you get taxed at 90%. Well, what's the point of trying to succeed in this country? I mean, we have an entrepreneurial country, entrepreneurial nature. People look at the wealthy and say, I want to be rich. No, of course not everybody's gonna be rich, but it gives you something to shoot for. It gives you some drive to advance. And especially since like the 80s, we've had an enormous amount of wealth creation in this country. And a lot of that is due to economic growth and the growth of businesses. And look at technology, look at healthcare, look at these industries that have created enormous amount of wealth in the last 40 years. And a lot of that I would attribute, you can never say for sure, but a lot of that I would attribute to lower tax rates, because now it gives people an incentive to work harder. Hey, I can make $1 billion and I'm not going to get taxed at 90%. Maybe it's 50%, but hey, I'll have $500 million. That's certainly better than 100 million, right? So I think when you're looking at this, if you're looking at, the right way, there's a lot of impacts here. Taxes is a big part of it. Now, I'm going to get into more things, but Doug, what's your thoughts on this when it comes to that, when you see these charts?
Well, I think you mentioned a couple things there. First of all, I think you have to take a step back and also just kind of think about what is wealth, right? I mean, you were talking about the impact and who gets impacted by this. And I remember you may remember the times when there were these lots, kind of the meme. There was a lot of, before memes, because I don't know, back then they didn't have memes, but it was these homes, these huge McMansions, they talked about it, that didn't have any furniture, right? Because people were stretched. And there's the wealth in this country is tied to mainly one of two things. It's the income you make, but it's also the assets you own. Okay. And so what is wealthy? There's a lot of people in this country, and we usually talk about wealth in income. The top 1%, some of this data might be a little outdated, but the top 1% earn around $550,000. Okay. Now they pay about 38% of all taxes. The top 5%, to be in the top 5, you have to earn about $221,000, and they pay about 60% of all taxes. Okay. Now that doesn't sound like a lot these days to earn $221,000. It might to some people, possibly not to a lot of your listeners, but it does, and you're in the top 5%. So it's not an ordinary income. The issue with this is if you get this kind of income and it's paid to you, this is where you have issues with taxation. It also means that, even though you may not be at the bottom level of income, you might be at a higher level of income, but your standard of living has adjusted accordingly too. So there's a lot of impact to inflation that can impact, just a little bit of a change there can be a tremendous shift in the economic viability of even higher earners. So people like to talk about, the top, wealthy, they don't pay any taxes. Well, the reason they don't pay any taxes is because they're not paid the same way. They have assets, and those assets they hold comprise a significant portion of their wealth, may give dividends, may not give dividends. And so, when we start to talk about who is wealthy, and we tend to look at this based off of income, unfortunately, income taxes doesn't necessarily address the concerns that a lot of people have, right? And that's why you start talking about things like wealth tax. But then that creates an enormous amount of additional problems that can come from that, because wealth can change very rapidly based on valuations. And if you're taxed based on that valuation, but then have a shift, how many companies disappeared back in the 90s with the dot-com bust, right? And all of a sudden, that wealth was there and is gone. But if you taxed off of that wealth, where's the money to pay it, right? So, and that goes back to, I think, another thing that is really important to look at this, and why there's been some, discrepancy and really some impact with regards to income inequality over those last 20 years or so, and 30 years, is a lot of that has to do with, like you said, technology. Technology leads to automation. Okay, that has been the biggest thing that has changed. I don't know if you heard this, Kirk, but George Jetson was born the other day. It's been going around that officially he has. And if he was born the other day, that means when we watched the show, The Jetsons, which of course was out before we were born, but we've seen it. George Jetson was probably what, in his 30s during that show? Well, if you fast forward to where he's going to be in his 30s at the time of the show, and flying cars and things like that, I hate to say it, there's maybe some reality to this still, because if you look at where technology's gone in the last 20 years, and the automation that's created, and the elimination of jobs that's created, and the need to not have to pay as much for the demand of a workforce over the last 20 years. If you're familiar, your users or your listeners can look up Ray Kurzweil. This is basically the godfather of artificial intelligence. And he predicted about 20, there's a great Time article on this. I can, we can put a link to, but in 2045, they call it the day of singularity. It's when artificial intelligence is going to come alive. When I look at when I look at George Jetson and I look at where he was in the show, that is just the epitome of what is going to continue with technological advancements over the next 20 years. Look at what's happened. I watched a movie the other night with my wife. It was from 2005, and the phones they were using, I mean, it looked like you needed two hands to talk. I'm like, that's not 2005. It's got to be 1985. That is how much has just changed in the last 15 years, Kirk. And I think technology is an incredible driver. And, they talk about the compounding of technology every couple of years now, right? And what that's going to do, it's creating, unfortunately, a problem that may not be resolvable with regards to the income inequality, because guess what? There is going to be less and less and less need for people to pull the levers and push the buttons. And now where do those individuals find a way to make a decent wage? And
Yeah.
that's a huge topic.
Yeah, and that gets into the topic of universal basic income, which I'm not a favor of, but I can understand where that sentiment's coming from. I think that the challenge is when people talk about things like universal basic income, there's a large amount of guilt coming from some of the tech people that have made enormous amounts of wealth, and they feel guilty that they need to make sure that the poor people are getting income because what they're creating is going to take their jobs away. But I think we've seen this in history. Every time there's like an evolutionary shift, this sentiment always goes around. When the printing press came out, people thought, oh my God, a lot of people are going to lose jobs. Okay. I mean, what happens is the economy evolves to that. And all of a sudden those people repurpose and they find new companies. So as an example, and I'm not going to try to predict the future here, but if you say, all right, well, you're entering data and your job is basically removed by AI, well, maybe you repurpose them and now you're programming AI instead, right? So, I mean, jobs aren't generally created or destroyed. They're generally just changed, and I would argue that I know what's his name, the Senator John Kerry from our state made some comment about, well, these oil workers, they can just retrain and go work as solar panel manufacturers. I'm like, where? Are they going to move to China? Such a ridiculous comment. But at the same point, like there's a truth to that, right? Except for, I'm not a big fan of Kerry, even though he's from my state. I think, there's some truth to that, right? Is that in any economy, there is a repurposing of jobs into different sectors that are growing. And one of the comments you made, which I think is really important, which is, well, two comments here. One is incentives, right? You need to incentivize people for that growth. If there's no incentives, then why would I go to work? Why would I mean, think about this. Like most people listening to this, we have a relatively balanced life. But if you look at like a CEO of any company, their life is not balanced. They have prioritized company over family. And that's a huge commitment. I'm not saying it's right or wrong. I mean, everybody has to make their commitment, right? But at the same state, like it's not like they've got this perfect life and they're running a company. The company is their life. And if you look at these people like Elon Musk or, well, not Bezos now, but Bezos before, like these people were fully committed to running their company. And at some point, you can always change that. And of course, you can see people like Bezos and Bill Gates had their comeuppance with their marriages in tatters. I'm not going to claim why that happened, but I could say that it probably wasn't because they were home every day for dinner for a family dinner, right? There's a lot to that. So I think there needs to be some incentive to get this kind of growth in the economy, and it really takes a good amount of commitment from those people. Now, one of the reasons that we have this growth or we have this incentive is because of the asset growth. We've all seen this in the stock market in the last 40 years. And, productive assets tend to grow and people want to invest in those assets, which perpetuate that growth. So as long as you have this positive reinforcement loop in the economy, it tends to push it forward. And we have historically over the last 100+ years, we've had that ingrained in our culture here where people want that opportunity. They want to make a better life for themselves. And if you get to a point where you're France, where you don't have that and people just aren't incentivized to go do that, and there's a lot of countries that don't, some of the Scandinavian countries don't have that with the high tax rate, then you get a lot less innovation. And one of the things that's great about this country is innovation. So even though we talk about inflation and how bad it could be, there's still a bright side. There's still a bright, sunny rainbow in the future, because the technology is still going to evolve. Healthcare is still going to evolve. Our lives will, in essence, still be better. It just won't feel like it in the moment, because it'll feel like, oh, I'm stressed out because I don't have enough money, or I got to pay more money this year. But at the end of the day, your quality of life will inevitably be better than most people on this planet. So I think it's just important to keep that in mind, because a lot of us get caught into the day-to-day. And if you take a step back and realize, like, we're still in the top 10%, like virtually everybody in this country is still in the top 10% of the global economy when it comes to income. So even though whatever you think of yourself and your situation, you're still making a lot more than the vast majority of people on this planet. So I just have to point that out, because I think, perspective is really important. Now, one more point I want to hit on this income equality before we kind of move on and wrap it up is, we've been talking about inflation, and I would be remiss if I didn't point out the inflation impacts on this chart. But if you look at it magically, you'll notice, 1981 is really, after that is where the top 1% of earners, their incomes started to take off. Wow, look at that magic. Well, let's talk about that for a minute. Okay, you think, whoa, are they earning more? Not necessarily, right? It doesn't mean necessarily that, the rates peaked and all of a sudden their salaries jumped 100% in the next 5 years. That's not really how it happens. Tax rates are certainly part of it, but if you look at inflation, think of it this way. We talked about this before. I'm going to use my hands, so if those of you watching YouTube, you'll benefit from this. But you start out with your economy of like this size, right? It's just whatever it is. It's the size of a baseball, right? And then as interest rates drop, it starts to grow, right? Now it's the size of a melon, then a watermelon, and then a beach ball. And then, as interest rates drop, the economy is allowed to expand because people use leverage. So the reason that interest rates are a problem is because it harms people with leverage. If you have a fixed rate, you really don't have much to worry about. But if you have a variable rate, and this is why we brought up credit cards earlier in the show, it's a huge problem. You've increased credit card debt, and the credit card rates are variable. Well, that's a problem. What if interest rates go from, credit card interest rates were like 15% before rates started going up, but let's say it goes from 10% up to 20%. Well, now it's going to cost you a lot more for that debt, which means you're going to be spending less money, and it's just an impact. But now, if I can borrow, let's say in 1981, interest rates were at 20%, and let's say 10 years later, now they're at 10. Well, I can borrow a lot more money. I can go buy more real estate. Instead of one property, now I can buy 3 properties, right? So you're able to leverage yourself. And a lot of the wealth that's been created in this country has come from real estate, has come from the growth of public companies and private companies. And a lot of that is from the use of leverage. And the leverage is basically borrowing through debt, productive borrowing, not credit card debt. That's not productive. Productive debt is a company borrowing money to expand, to grow their revenues, and to grow their profits. Borrowing money to buy real estate, to rent it out for rental properties, is productive debt, because even though you're paying a mortgage, you're getting income to offset it. So that's productive debt. Borrowing your credit cards, borrowing to buy a car, that's not productive debt. And actually, I would argue that borrowing a mortgage on your house, I know I'm going to get probably people cancel after me saying this, but if you borrow to get a mortgage, that's also not productive debt. That's a way you can get a house, but it's not productive debt, because your house is not an investment. I know I've said this before. Your house is not an investment. It is a personal expense. There's nothing wrong with it. I'm not judging, because we all do it. What I'm saying is you have to recognize that it's not an investment. It is a personal expense. So if from a financial perspective, run the math. There's a lot of reports on our website. We have a calculator that shows exactly where the numbers are. You'll find out if you run the numbers, it is not an investment. If you want an investment, invest in the stock market, invest in rental property. An investment is something that's either appreciating or generating cash for you. And if you own a home, you're basically just paying for somewhere to live, which is fine. Whether you rent or own, doesn't matter. You have to pay for somewhere to live, but don't think of it as investment. If you do, I think you'll be a little bit disappointed. So any follow-up thoughts, Doug?
Yeah, well, I'm gonna tack on to what you just said there on a couple of things. Well, first of all, you made a comment about balance in life, and I think there's been plenty of research. Purdue University put a research article out that talks about that the magic number to be satisfied with life was around a $95,000 salary. Well, which is a deal, although 60 to 75,000 it satisfies an emotional well-being. And I think the reason for that too is that as people start to get more income, they buy more stuff, they got to manage more complexities, and and a lot of people end up falling out of balance. So I think that there is a huge give and take between work and life and what it takes to be able to afford what creates happiness. Now, the other thing I would go back to is I agree completely that a house is not an investment. And I think that, the arguments one argument is that, well, then that's why I should pay it off as quickly as possible. And I think that that is also something that has to be looked at, of course, with the interest rates. But there's that same reasoning and logic is a reason that you in many cases, especially where interest rates were in the last 10 to 20 years. But basically, if we were at 2 or 3%, you shouldn't put an extra dollar at all towards paying that mortgage down. Why? Because you're just giving that money back to the bank. If you want to and have money you could be putting towards the house, take that money and make an investment. Put it elsewhere and be able to have that money work harder for you, because extra payments on your house isn't actually investing in your house. It's just paying the bank off. You could have that money work harder for you in other areas. The other thing too is this is going back to the wealthy and the taxes. A lot of people started complaining a couple of years ago when they lowered the corporate tax rate, right? It's like all these discounts that corporations are receiving. Look, corporations are entities. They're not people, right? So the corporations that get these tax breaks, it's not benefiting the corporation. The corporation's not out there living a better life for it, right? The people that work for these corporations are employees, and they have the opportunity. They either own the stock or they get stock options. They have the opportunity to buy the stock. I'll let you in on a little bit of secret. So do you. So if you have an issue with a corporation getting a tax break because that corporation may now end up making more profit, here's how you fix that problem. Don't complain. Go buy the stock. Because guess what? You can own that company too and benefit directly. You can get benefits from the increased dividends that it might provide, or you can get benefits from the increased wealth and growth that that company may provide. Again, it'd be one thing if you're giving a tax break directly to an individual, and this is another, we look at we look at that discrepancy between the highest and lowest incomes or wealth. You might have some argument to say, lowering taxes really helped the wealthy more than it did the bottom class and the middle class. That's an argument. That's a political argument. I'm not going there. But for corporations, for public entities, if you really want to fight against that argument that they shouldn't have lower rates, go out and buy the stock and participate in the benefit of it. They're public entities. And this comes down to making prudent financial decisions, which, Kirk, unfortunately, most people just don't do, which is why we're here to teach today, because you can take advantage of much of these things that people unfortunately complain about.
Couldn't agree more. Well, I want to touch on one thing. I know you love the show. I do get a lot of love mail and hate mail from people who listen to the show. I certainly prefer the former, but I have a thick skin if you want to send the latter. However, I do need to ask you a favor. We're looking to expand the show with a lot more resources and high-end guests. You're going to love what we have in store for you in the upcoming months. However, now I need your help. I need 5 to 10 minutes of your time to help influence the direction of the show. We're doing our annual listener survey to help understand our audience better. I know you're busy with your life. Well, I am too. My kids are going back to school, and that leaves me less time for other things. But as a listener of the show, I could really use your feedback. I'm not the government, so I'm not asking you to work for free. So in exchange for 5 or 10 minutes of your time, I'm going to give you a gift of over 100 million Zim dollars. That's right. I'm giving you a gift of over 100 million Zim dollars in exchange for 5 to 10 minutes of your time. Go to moneytreepodcast.com/free money to get your free money today. Well, I want to touch on one thing, and then we're going to wrap up here in the interest of time. And the last thing is, we talked earlier about the bullwhip, and I just want to get this point in because I found an interesting chart, which I thought was, I think would be relevant here, is that you know, as we're looking at the economy now and where things are, you know, we had, I think it was, I saw a stat that said we have the July was the 5th best month in terms of performance in the last 30 years. Now you think, well, like we're in this bear market, the market's down. Well, July was the 5th best month going back 30 years, and this is for the Wilshire 5,000. I'll put a chart in there. Does that mean the bear market's over? Not necessarily, right? And I think this gets back to the bullwhip effect. It talks about like, what is a bear market? Why is it dangerous? This is why it's dangerous. I'm not saying stocks are going to crash from here. I don't want people to take the wrong impression. What I do want to say is that just because we're in a bear market, it doesn't mean we can't have what we call a bear market rally. A bear market rally is a point in time where the sellers are exhausted, and then people say, hey, this is the bottom, and they jump back in and drive the price up, which works, right? It did in 2007, right? In August 2007, the market crashed 10%. By the end of the year, the market was higher than it had been prior to that crash. And then, of course, 2008, you know what happened there, and the market's just imploded over that full year. But the point is you have these periods in time, and even 2008, the markets dropped, and then they rallied and went up, and then they dropped again, or came up. And it's just this back and forth action. This is normal. This is what is expected in the market. Now, you know, if the markets hit an all-time high from here, I'd be really shocked. But I think it'd be hard to imagine that that's gonna happen given all that's going on with interest rates and inflation. So unless inflation starts to go negative, I think we're in. I think we need to be in protective mode and risk off mode. But the point is, if you look at this chart on the, if you look at this chart here that I'm showing here on the technology sector, it really just shows like we're at the top of a channel. Like the markets have rallied quite a bit in the last month, and we're at the top of a channel. Maybe it keeps going, but if you look at history, you'd say, well, the odds are low that it's going to keep going higher, right? It could, right? Nobody knows the future. And I think you have to acknowledge the fact that I'm not giving you a recommendation. What I'm saying is that you have to look at this and say, you know, based on history, based on how people are looking at it, the technical analysis typically is a showing of what people are interpreting history as. So there's a reasonable probability that, you know, the markets drop from here. But I think what's normal is the expectation that things are going to be volatile for the foreseeable future. And I think that's the takeaway here. It's not what the market's going to do, because I don't know any more than anyone else listening to this. But I can tell you that the markets are going to stay volatile, because that is what this bear market is creating, is a volatile environment. So it's going to wrap it up here, Doug. So final thoughts from you, and where can people find more about you?
Yeah, some final thoughts is also, you know, one thing to keep in mind is that we're in the summer, right? And with the summer, trade volumes are significantly reduced according to the rest of the year. So if you look at the rally that occurred recently, it was on fairly low volume. So you get these big swings because Wall Street's basically on vacation, right? So you get these big swings that happen right now, and I don't think they give a really good indication of what is going to come, whether to be bullish or bearish. And no matter, but I will say that if you look at some of the charts that are out there, you know, again, we always talk about that, right? If you lose 50%, how much do you have to make to recover? Right? It's not 50%. You've got to make 100%. And so what's happening right now is, and again, we can look at the info sector, specifically XLK, which is an ETF out there that tracks it. Information technologies, we are seeing these sharp declines and sharp rises, and followed by more sharp declines. And even though they're going back up significantly, and this happens, right? Markets drop, they tend to rise again, and they tend to rise quite a bit when they drop sharply. We are starting to see that the pattern of the rises are not reaching where they were before. And why is that important? Because a lot of people like to invest in things like the S&P 500. You can go out to sites like FinViz, where you can look at what's in the S&P 500, and guess what? There's a ton of technology. The biggest companies in the S&P are tech. So it is a really important indicator that even though it's going up and going down, it's continuing to show a longer trend of decline, which means, yes, you might be getting optimistic about what happened in July, but because of the low volume and because of the pattern here, it still warrants caution. If you really look what's happening at the warehouses, and you look at what's happening with default rates and credit, there's a lot of things that are occurring that are not good, right? And those things can have greater effect. And even though everybody's happy right this second, the numbers came in from last quarter, you got to think about what's going to be happening in the quarters to come. So just be careful. And again, that's where, the advice, the active advice that you get from Kirk's team and others can be really helpful in helping you to weather this volatility and risk. My name again, Douglas Heagren with mergentgroup.com, but also for those of you out there listening that are that have kids going to college here in the next 4 to 5 years, especially if you're a business owner, most of you are not taking advantage of significant tax breaks that could happen to send your kids to college. If you'd like to save a lot of money on tuition just in tax strategies, it's important to do so. Again, colleges they've got lots of money to give, but they don't hand it out to you if you don't know where to look. It's a game. You're playing the game wrong. Let us show you the rules. You can go to ProCollegePlanners.com, learn more, and reach out to me to have a conversation.
Great. Thanks for coming on, Doug. And yeah, I highly recommend if you have kids from 7th grade up to 12th to reach out to us. I think from Doug's perspective, Doug is an expert in this area, and he's done a lot of great things for clients and helping them save money. Colleges are expensive, and he's a master at finding those little nuances of where you can find savings and help your kid get into a good college without going broke. So thanks for coming on, Doug. That's the show for this week. Thank you again for joining us on Money Tree Investing Podcast. My name's Kirk Chisholm, wealth manager of Innovative Advisor Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com. And of course, you can find me every week here on this show. You can also check out our show at Money Tree Investing Podcast. On our website, you'll have access to the show notes, resources, and the archive shows. Please remember to subscribe on our YouTube channel for immediate access to the new shows when they're released. When you subscribe to the show, it allows us to get access to some of the top minds of investing in personal finance. While you're here, please leave a comment and question if you want us to address it on the show. Have a great week ahead, and remember, no one will care about your money like you do, so invest in your life.